Good evening, all. Ira Epstein, and here we are with your SPDR ETF stock market wrap-up, and this wrap-up is for the evening of Sunday, and this is the 13th of July, 2025. Well, what an interesting time. So over the weekend, we saw that 30% tariffs have been now on Canada, Mexico, and the European Union. So we know where those are. We know where the copper tariffs are, more and more information. And you've got to ask yourself, with all this and the government having already collected $100 billion in tariffs, that's what the running number looks like, why hasn't it shown up? And my answer is it takes time for the government data to display the data. It's coming. These companies are not going to eat all of this. It's going to come at you, and that's why the Fed is being so careful. Now, I, for one, don't think a tariff impact is a one-time event. You take the number up, and then the big question is, do you go higher because it's going to stay where it's at, and you get your normal business increases, whatever it is, because everybody's going to see something happen to them in costs, all right? And it's not down when you get these tariffs, it's up. Or do we get to a point down the road here where these tariffs get reduced enough? You heard what I said, reduced enough. They're not going under 10%, but reduced enough to be pretty much a non-event where everybody starts eating a portion of it and the consumer doesn't pay all that much. We don't know the answer to this yet. If you think you do, congratulations. You don't. I don't. The Fed doesn't know. We're all waiting to see when the data is going to show. The fact that it hasn't shown yet is the laggard effect, in my opinion. I could be wrong, obviously, on it, but that's where I'm seeing it. So when I looked at the futures tonight, you're down in the stock market moderately. Not a big break at all. 20 points in the S&P, 150 in the Dow. You're down in most currencies, not all, but most currencies against the dollar. Bonds and notes were flat, and energy markets were flat. So once again, the market slips back, and the question is, do we see this as the buying opportunity, which is how traders have been playing these markets right on through? Otherwise, you wouldn't be making new all-time highs. So with that in mind, let's again look at Netflix, which has finally pulled back. As you know, I was saying when the market broke out from here, it's probably going in $50 increments up and down. And it pretty much did that and peaked out against the $13.50 level, and suddenly we're back to $12.45. So that's two of the $50 elements. Is the market going to keep breaking? Well, it can go to 1,200 and still not violate the 1180 number that we have on the last break low. Number two, the moving averages are far away. If you come down here, you break this chart pattern completely, and you'd have to go to 1116. It could certainly happen, something you have to consider. The market peaked out, didn't hit the Bollinger Band after it ran it for a while up here, and now it's come back into a normal area, as I call it, but you have your embedded reading. So I think momentum's leading the trade. And as long as this momentum reading does not close under 79 by the end of the week, I think traders are going to use this break to start accumulating Netflix. Restoration Hardware came up and got to 217.60 this week. Still hasn't taken out a prior high. It's really caught against the 18-day average, sort of just sitting here. You got the bias up, the trend down, and the momentum trying to push up. But even if it rallied big, I don't think it's going more than $30 higher. But $30 would be an interesting move for a $200 stock. I just don't see it yet. Could it happen? Absolutely, but I don't see it. In Starbucks, you finally got to close over the 18, the 100, and then gray the 200-day average. You're overbought. Look for the market to fight a battle. I don't think it's going much beyond 94, but it's got good news going forward, especially if you can get rid of that Chinese business, the way they're, if you will, redoing the stores, trying to make speed very important to what they get, fewer items. I like how they're trying to rebuild and rebrand themselves. Lilly, for the first time, back over the 18-day average on an outside week to the upside. Notice how the market's been fighting a battle at the 100-week in green to stay over the market. Is this enough to kick the market? Well, it could be. What you don't want to see is this week's low of 762.03 taken out. It did close against the highs of 793. Now the question is, can you clear 802.5? And if you do, 876 could be your next stopping zone. It's trying to come out of that sideways action in a big way. You did so already in Home Depot. And just like I mentioned in Lilly, if it goes, watch the Bollinger Band, well, this one's already done it. So you watch the Bollinger Band. It got there, it got thrown back. But this sideways action, is this going to be base building? We're going to find out. Is there a trend here to trade? Not yet. You still have a higher high and a lower low. That's not exciting to me. Uber. What can I say? I like this company a lot. I like it fundamentally. I like their rideshare programs. I like autonomous driving. They'll participate in it in many manners. You've got the higher lows, higher highs. You can see how the market's trying to embed. It's not there yet. Both numbers were over 80 this week. Let's get to last week, the third. Both were over 80, but not the week before. So you're overbought. This is where the market is somewhat vulnerable for a pullback. So be a bit cautious. In DoorDash, look at how the market's come up. We started covering this back here for a reason. I thought the market would move to a run. One of the subscribers that watched me on YouTube wanted me to cover this, and it was a good thing they did. They were right, and the market has come alive. I like what I'm seeing. It's got the bullish embedded reading. Breaks this week could be a very interesting way to come into that market. In XLI, the industrials, they don't look weak in any manner at all. So we'll see tomorrow if they get hurt in anything. But so far, they've seen the tariffs. They haven't done anything. They've gone to new highs for the whole move. This is a sector that is very, very strong. Energy's come back. The IEA on Friday did not agree with OPEC. That doesn't mean anything. We'll see how this all plays out. We'll see. OPEC is grabbing its market share back. I think it's going to be very careful about how far it lets prices run, but the fact that they're higher helps the XLE. Remember, a lot of this has to do with the refineries that make money there, how things will work. Get up high enough, maybe you get more drilling going on. We'll see. Right at these current prices, I don't see the U.S. increasing its oil production. Lower highs, lower lows in UUP, the dollar. Okay. Gold. Can't even get back to the 18-week average. It is overbought, so it's not my favorite thing right here. Copper, obviously, you had that monster run. You're correcting in the copper miners now a little bit, but where are they going to the downside? If copper can stay at these type of prices, and that's going to be the big question, can it stay at $5.50 thereabouts? Well, eventually that comes into these boys. If they're not hedging, I'd be surprised. I'm talking the miners. They can hedge against what they produce. So we'll see what goes on. You have your embedded reading. I'll be covering this in a lot more detail in the morning in my subscriber videos, because then the world will get to see the reactions. So by the time we all wake up, should be an interesting morning. So if you look for trade ideas, that's where I put them. If you look for me to say, hey, buy here, sell that, be it spiders, stocks, ETFs, that's where I do all this. And I track them. I mean, we have trades on now nearly 2 years. So some of it's long-term, some of it's short-term. I approach spiders, ETFs, stocks completely different. And you got to put on two different hats when you do this from the futures markets. Futures are more the hit and run strategy because of 90% leverage. Stocks are more about play the momentum for the trade, and that can last longer than it does in futures because the leverage isn't as high. I know people argue with me sometimes about that. I don't think they're right. I've done this 5 decades. Leverage is it has a big influence on how traders approach markets. Just go to IraEpstein.com, the word research, join us. The icons are up here. I'll catch up with you all in the morning. Have a great evening. Look at the other videos tonight, please. Give us a thumbs up. Take care.